Has AT&T stock finally bottomed? And I mean, we're talking after going on a downtrend for over 5 years now. Has this stock finally turned the corner? Is it going to start trending up? We'll talk about that from a technical perspective, but also in context of those Q3 earnings that came out before the bell today. What is going on, investors? Hopefully you guys are doing well out there. Time to pick up the story again of AT&T. Over the last year, hasn't really been that bad. Down only 14% year to date, down about 12%. That's after being up huge today, though. Over 7.75%. The stock soared after reporting earnings that certainly beat expectations that Wall Street had for the company. Revenue coming in right at about $30 billion. We'll jump over the numbers here in a moment. We'll show you the revenue. Obviously, you've got very slow growth of this company. They're offsetting that with cost cuts as well. Certainly not a formula that would work for a lot of companies, but in a market where you have just really two legitimate competitors, I actually think you can get away with it better than most companies can potentially do that. The $30 billion revenue mark was down 4.2% year over year. Wall Street was expecting a number closer to $29.86 billion. On Seeking Alpha, they show you that actually is 25% year over year revenue declines, but that factors in the fact that they had higher revenues a year ago because that Warner Brothers media business with HBO and Discovery and all those other channels and TNT and CNN, that was inside the portfolio. And that was generating several billions of dollars worth of revenue every quarter. And so something like this, which is computerly generated, is not going to be sophisticated enough to understand these things. And so you see over the next couple of quarters that AT&T has this big negative growth rate. But again, factor that in, that actually is not factoring in that they've subtracted a large percentage of their business. We'll certainly see evidence of that when we get over to these financials as well. They beat expectations on that revenue side, beat expectations on that earnings side. They upped their full year guidance for their adjusted EPS number, coming in at closer to $2.50 or higher. Previous revenue estimates was between $2.42 to $2.46 per share. Consensus was closer to $2.55. My guess, that's probably the number that AT&T is probably going to come in at. It was a particularly strong quarter for AT&T Fiber, which I have here at my home. It's incredibly expensive, but it is worth it if you run your business from home. They had over 200,000 net ads there. That was 11 straight quarters of more than 200,000 ads, and it was actually their second best quarter ever. That is leading to higher broadband revenues. Those are up 6.1% year over year, with revenue growth of more than 30%, as the cost of that fiber subscription just incredibly expensive. But again, I think it's worth it. For those revenue estimates, this company is basically flatlined, right at about $30 billion. Wall Street not expecting it to get much higher than $31.5 billion. You have some high-end estimates heading into next year where maybe they get to $32 billion. But this is basically a no-growth business that trades at a minuscule price-to-earnings ratio of about 6, has a price-to-sales multiple that is actually under 1. You have a market cap of just a $111 billion. And again, on a company that has a $30 billion run rate per quarter. So they're generating about $120 billion worth of sales in a year. And the whole company is worth $111 billion. You've got a gigantic yield on this one, although that's probably going to come in a little bit as the stock is making a little bit of a momentum turn from its price, but you still got a yield north of 7% at the current time, at least how it's stated here. Probably if the momentum stays in the stock, higher than 6.5%. This used to be a dividend reinvestment and kind of a retirees type of stock, but obviously this stock has just been on a monster downtrend for not just 1 year, 2 years, 3 years, but we're talking about consecutive years, 6 years or so. The stock is just continuing to fall. Has it reached a bottom? We'll talk about that from a technical perspective here in a moment. I do want to get into these Q3 earnings as they certainly topped estimates both on that top and bottom line. Here is our total operating revenues coming in at $30 billion. Last year, they were about 4% higher at about 31.3. Again, that's X, the Warner Brothers media division. So this 4% is just a comparable AT&T business. So they are contracting from a revenue perspective, but they're offsetting that with the operating expenses also going down 4.2%. So you saw the revenues decline by about 4%. You saw your operating expenses decline about the same amount. Your operating income actually went down about 3.6% from $6.2 billion to about $6 billion. So off $30 billion worth of revenue, you had about $6 billion worth of operating income. That's about the run rate they're on. They were obviously a little bit higher in subsequent quarters because for the 9-month period, you printed roughly $90 billion worth of revenue. Again, they're on about a $30 billion run rate per quarter, and they're on about a $6 billion operating income, maybe slightly lower than that in sub-quarters, as they printed about $16.5 billion worth of operating income over the last 9 months. That is down 21%. So that actually exceeded their revenue drops of 13% over the last 9 months and 11% contraction in those operating expenses. My guess is the quarter that you're seeing right here on the far left-hand corner, that is the subsequent quarters. That's probably what they're going to look like. You're going to have about $30 billion worth of revenue, and you're going to have about $6 billion in change in operating income. Now, the all-important interest expense, we'll see more evidence of this when we get to cash flows, but also the balance sheet, is the mountain of debt that this company has. And now they've paid it off quite a bit over the last several months because of that Warner Brothers spinoff. They acquired a large bit of cash. They basically put most of that to the debt, but you were still paying $1.4 billion worth of debt servicing cost every quarter. That is down, though, 12.7%. And that is important because when you carry this much debt, obviously in a higher interest rate environment, that cost can really start to tick up. Obviously not necessarily in the shorter term, but the longer rates stay high, this company is going to have to refinance debt at a much, much higher rate. They did a nice job when rates were low over the last decade or so, borrowing lots of money at very low rates. But if you are the belief that the Fed is not going to be able to pull interest rates back, they're going to have to leave them quote unquote high. And I guess high would be anything north of 3.5%, 4%. If you think that rate is going to stay there for a prolonged period of time, for a company like AT&T, we're probably talking about more than 24 months. Well, that is something that is going to impact this company. And if you are of that belief, AT&T is probably not the stock for you, because yes, you are going to get a 6 to 7% yield on this one. But if you believe bond rates are going to be 4, 4.5, 5, I'd probably rather be in a company, or like a bond fund that's just, or a money market fund that is just spitting out 4.5, 5% in terms of its interest rate or its coupon rate, rather than be in a stock like AT&T where you're getting no revenue growth and you have that risk that they're going to have to refinance this debt at higher rates, and that interest expense is going to chew into those earnings per share. When you flow all the way down to net income, you see a little bit of benefit from the fact that they've reduced their debt year over year. So those operating incomes are down 3.6%, but their net income, okay, this is after you factor in things like interest and taxes and those types of things, well, it's actually up 2%. So you went from $6.27 billion up to about $6.4 billion. So your EPS on a diluted basis at AT&T was actually up 25% from 63 cents per share up to 79 cents per share. This is a company, I'll remind you, that pays $1.11 per share on that dividend rate. So they're churning that out, not quite in one quarter, but you see over the last 9 months, they've churned out over $2 per share in terms of earnings. So they have more than enough coverage on this dividend. So if there's anybody worried about this 6-7% yield, you don't really have to be worried about it, at least from an earnings perspective with AT&T. Again, in the shorter term, if you have rates stay high for a prolonged period of time and without digging into AT&T's debt, which you certainly can in the annual report, well, as that debt starts to roll over, it will roll over at a much higher rate. That's when I would get a little bit concerned about that EPS. But in the shorter term, I am not. From a balance sheet perspective, company has some cash. Okay, they've got a lot in, they don't have a lot in cash, actually, just $2.4 billion, but we'll show you cash flows and certainly the net income. This company doesn't necessarily need to carry a lot of cash. They've got plenty in receivables, obviously people that owe them money for different types of bills bills, from the cell phone to the broadband subscriptions and things like that. So they're constantly getting cash flowing in the door over at this company. Certainly had a lot more cash in the past when they were running that Warner Brothers media business. They needed to carry more cash because they needed to invest in content and those types of things. Well, they don't need to carry as much cash over at this company. They're still carrying a mountain of debt, like a mountain of debt you almost never see. Yes, last year it was at $151 billion. Now it is down to $123.8 billion. So they carry more debt than what the entire company is worth. The entire company is worth $111 billion minus the debt. Obviously, if somebody were to buy this company, they would have to pay off this debt or figure out a way to finance it. You're looking at $123 billion. So again, down, what is that, $28 billion year over year. But when we get to cash flows, this company obviously has to still reinvest heavily into its broadband and its cellular network. So that's where your risk lies with this company. It's not going to just be able to, it obviously was able to pay down its debt over the last year because of that Warner Brothers spinoff. They got a huge chunk of cash. They used a lot of it to pay down this debt. Certainly they have other assets to sell at AT&T, but far less than they did a year ago. When we come down here to the cash flow statement at AT&T, this is a 9-month period. They pull down net income of about $16.25 billion. Last year, you're a little bit higher. Again, this is excluding Warner Brothers Media. This is just a comparable business year over year. You had a little bit higher net income at about $18.6 billion. You get to add back things and subtract things, particularly your depreciation and amortization. That is a non-cash charge that you actually recognize here on the profit and loss statement. Here it is, and it's a big one, okay? $4.5 billion essentially quarter after quarter in depreciation and amortization in their property, plant, and equipment. When you come to the balance sheet, we talked about how they have very little cash, but when you look at their property, plant, and equipment, this is a company with over $127 billion worth of that. They also have those licenses, those spectrum licenses that they buy from the United States government. They have over $123 billion of that. So while they don't have a lot of cash and they carry a lot of debt, they have these assets, particularly these licenses, that you have to pay a 100% of the cost up front, and then you monetize it over a long period of time. Those don't tend to lead to very explosive growth rates and revenues and profits that really fluctuate a lot, but it can be a steady investment if the company is managed properly. You look at a Verizon, certainly a T-Mobile, certainly has had price appreciation. AT&T has suffered from very gross mismanagement from the executives. They've acquired assets that just never really worked out when it came to DirecTV and that Warner Brothers media division. So you had the depreciation, you get to add that back in. So you have $16.2 billion worth of net income. You have another 13.5, call it, when it comes to depreciation and amortization. That means your net cash provided by your operating activities is very strong. Okay, you're looking at over $25 billion. Last year on a 9-month basis, you're looking at about $29 billion. So this company is churning out about $8 billion over the last 9-month period, about $8 billion worth of positive cash from their operating activities over each quarter. And so that allows you to invest in those capital expenditures. During the last 9 months, they spent about $15.4 billion. They spent another, call it about $10 billion on acquisitions. So of that $25 billion, another 23 basically got spent on those investing activities. You come down here to financing activities. This is often very creative for AT&T. They had some short-term borrowings of about $4 billion. They repaid some short-term borrowings of about $16.9. They issued a very small amount of long-term debt, and they paid off a mountain of long-term debt here of about $24 billion. So in totality, you paid off about $16 billion in short-term and about $24 billion in long-term debt. That's about $30 billion, but then they took on another $4 billion kind of in shorter-term borrowings. They paid some dividends here as well, about 7.8. That is down year over year because the dividend rate per share was higher a year ago as they did that spin out. If you owned AT&T shares at that time, you got a portion of the WBD stock, I believe it is, and they reduced the dividend rate at the same time since you're retaining AT&T shares of a much smaller company. So they had to reset the dividend based on the cash flows and the profits of the existing company that remained with AT&T. All things being considered, you burn through over $52 billion. Okay, that includes $25 billion worth of positive cash flows. You burn through another $52 billion roughly when it came to cash over the last year. Again, most of that actually went to paying down debt and then acquiring more capital expenditures and more acquisitions at AT&T. Better hope those acquisitions work out a little bit better than the previous ones at AT&T. Now, has this stock bottomed? I've got a weekly chart with AT&T going back to like the mid 1990s when some of you were probably just a glimmer in your mom and dad's eye. I've marked out an area here with a green box where since the 1990s, this stock has found some footing down here between, we'll call it $14 per share and up to about $18 per share. It hasn't been in this area. Now, earlier this year, back in February, it kind of touched into this zone, but deep into this zone, it really hasn't been here since the great financial crisis back in 2008 and the early 2000s where you had this big dot-com crash. Certainly, there's been much, much worse areas to accumulate AT&T stock. It's where the stock is right now, and certainly a little bit lower anywhere inside this green box. Now, I would not make this the cornerstone of my portfolio. It could be a portion. Let's say you're a younger person like me, or we'll put that in air quotes because I'm almost 41, but we'll assume that some of you are out there watching in the same age and you have some high growth stocks. Maybe you have some REITs. Maybe you have some dividend stocks as well. This certainly can be a portion of a dividend portfolio, one that probably includes Nike, Starbucks, Apple, Microsoft. Certainly when we're looking at REITs and other types of higher dividend yielding stocks, those can be included. I think you can include Verizon in here as well. And obviously AT&T, it could be a small portion of that. If you are a retiree, so this AT&T tended to attract a lot of retirees because it was at one time a pretty relatively stable stock. And certainly from the end of the great financial crisis to 2015, 2016, it went on an 8 or 9 year run where you not only got a very high dividend yield on this one, certainly compared to the yields you were getting elsewhere, but it had a spectacular price appreciation as well. You're hoping it goes on another one of those runs. But again, if I was a retiree with where interest rates are now, where money markets funds are now, I'd probably rather be in a far riskless type asset, riskless type investment, whether it's short duration bonds or money market funds. I think are probably the safer place to be given the volatility that we've seen in yields. But the performance on this one is good enough to where I probably would recommend it in some dividend funds. Again, wouldn't be the high, like if you had a top 5 dividend, this one would fall just outside the top 5, where I'd probably have Starbucks, Nike, Apple, Microsoft, and probably some healthcare and some other dividend REITs. But just underneath those, I'd probably have a Verizon and an AT&T. Not the worst place to accumulate this stock. If you're very risk averse, I would have a stop loss underneath at about $14 per share. You wouldn't want to see this one get below that, because then we're treading in territory that we haven't seen since almost the 1980s when I was a little boy. Hopefully guys enjoyed today's video. We'll be back again tomorrow with our FANG stock recap show, and obviously all next week when all the major FANG stocks report their earnings. Hopefully guys have a wonderful day out there. Good luck with your investments.